So now let's add a second question to the same scenario. We're still dealing with the same company that we were dealing with before, just I'm starting to run out of room on the whiteboard. So let's say the company decides to keep the all equity capital structure. So they're not going to convert to that 40% proposed capital structure. However, you as the shareholder prefer the 40% debt capital structure. How can you use homemade leverage to replicate the levered payoff? So in part one, if you remember, the cash flows to us as the shareholders when the company was unlevered, we found that to be $666, and the cash flows to us when the company stayed levered was $775. So notice how we're here and we want to get to here. And that's fine, the cash flows are higher. Now, as a side note, these cash flows are higher. However, this is happening specifically when the company is making earnings before interest and taxes of $40,000. If the earnings before interest and taxes goes down, remember with a levered company, those losses are going to be magnified. So you're going to have higher losses than if the company stays unlevered. So there is a potential for higher cash flows, but it comes with greater risk. But anyway, in this specific scenario, what we're trying to do is we're trying to go from here to here. Now, if you remember at the beginning of the lecture, I mentioned if you want to increase leverage, you own stock, what you have to do is you have to borrow personally. And then when you borrow personally, you have to buy more stock. And that will help you replicate the payoffs of a levered company. It's going to give you levered cash flows. The question is how much do we borrow personally? And what you want to do is you want to replicate the debt to equity ratio of the levered company on your personal side. So I will further explain that, go into a little bit more detail. So let's first figure out what the debt to equity ratio of the levered company is. If you remember, if you go back to the balance sheet of the levered company, the debt was what? It was 151, 200, and the equity was 226, 800. So the debt to equity ratio, we would just take that 151, 200 divided by 226, 800, and we would get 2/3. So that's the debt to equity ratio of the levered company. And in fact, you don't even have to go through the process of putting these big dollar amounts. Another thing you could have done is, if you remember, it was just mentioned that the company is going to have a 40% debt capital structure. So you could use even smaller numbers. You could say if the assets were worth $10, well, 40% of 10 is 4, and that means the equity has to be 6 for the left and right side to balance. So then the debt to equity ratio would be 4/6, which simplifies to 2/3. So that's another simpler way to get that debt to equity ratio of the levered company. So what does this mean? Replicate the debt to equity ratio of the levered company, which we have on your personal side. So how do we replicate it on our personal side? Well, what is our personal equity currently? Well, we own 150 shares of this unlevered company. And if you remember, this company has a share price of $42. So if we multiply these out, 150 times 42, we get 6,300. So currently, we have $6,300 worth of our own money invested in this company. So that is our personal equity. So to now figure out how much we have to borrow personally, our personal debt, we have to make sure that that ratio is going to be same as the debt to equity ratio of the levered company. So I'm going to erase all of this here. And here's how you would do this. So your personal debt over your personal equity, which we figured out is $6,300, has to equal the debt to equity ratio of the levered company, which we know is 2/3. So instead of putting personal debt, let's pretend that that's just a variable x that we are solving for. And now to solve for that, we just cross multiply. So 3 times that personal debt, or 3 times x, gives us 3x. 2 times 6,300 gives us 12,600. And then dividing both sides by 3, we end up getting 4,200. So that is how much we have to borrow personally. So that is going to be our personal debt that we have to take on. And if you remember, the assumptions that we stated for homemade leverage is that individuals, so us in this case, and corporations, companies, borrow and lend at the same interest rate. So since the company had debt where it was paying 8% interest, we're going to have to pay 8% interest on this loan of $4,200 as well. Okay, so I'm going to erase this and just put a summary so far of what is happening. So currently we have some personal equity of $6,300, and that is from 150 shares. And now what we're going to do is we are going to borrow 4,200 personally at 8% interest. And now what we're going to do is we're going to take that amount, 4,200, and we're going to buy more shares of the company. So we're going to buy more stock. So furthermore here, in this scenario, the number of shares that we are going to purchase is going to be what? Well, it's going to be the amount of debt that we took, $4,200, divided by the share price. And the share price is $42. So we are purchasing $100 more, or 100 more shares rather, sorry. So from all of this now, what's the end result? Well, we own now 250 shares, and we have $4,200 worth of debt that we have to pay 8% interest on. So from that whole process that we went through, this is our result. We now have 250 shares because remember, originally we had 150 shares, but now we took on debt and we used that debt to buy 100 more shares. So now we have 250 shares and we have $4,200 worth of debt that we have to pay 8% interest on. So now what I want to do is I want to take our new situation, us owning 250 shares of this unlevered firm and having $4,200 worth of debt, and I want to calculate what our cash flows are going to be. So this 250 shares, it's still 250 shares of this unlevered firm. And if you remember, the unlevered firm had an earnings per share of $4.44. We calculated that in part 1. So it's still going to have that earnings per share of $4.44. So 250 times $4.44, that gives us $1,100 All right, so that is the cash flows now that we are receiving with this 250 shares of this unlevered firm. So 250 times that earnings per share that we calculated in part 1. And now we have to pay 8% interest on this debt. So if we take $4,200 multiplied by 0.08, we end up getting 336. However, that is a negative cash flow to us, so we'll represent that with brackets. So we're getting $1,110, but then we have to pay $336 worth of interest. Well, what happens when you net those out? When you net those out, you end up getting $774. And notice how that is very close to the cash flows that we had when the company was levered. In fact, they should be exactly the same. The reason why they're not is because we did a little rounding. When we calculated this, we rounded the earnings per share of the levered firm in part 1, and then the earnings per share of the unlevered firm, $4.44. That is rounded to 2 decimal places as well. But if we didn't round anything, both of these would be exactly the same. So notice how we went from these unlevered cash flows personally of $666, and what we did was we personally took on $4,200 worth of debt to replicate that debt to equity ratio of the company. We used that $4,200 worth of debt to buy more shares, so now we have 250 shares. So now our positive cash flow is going to be $1,110, but we have to pay 8% interest on that $4,200 worth of debt, which would be $336. And when you net those out, you end up getting $774, which is the same as the cash flows that we had if we converted, or if the company converted their capital structure to 40% debt. So notice that we replicated that payoff with homemade leverage, with personal borrowing on our personal side, and the company is still unlevered.